Most people enter the world of investing with the same goal: to grow their money. But despite this, the majority of investors end up losing or underperforming the market over time. This is not because investing is impossible, but because most people approach it with the wrong mindset and the wrong strategies. In this video, we will explain the real reasons why most investors lose money and what separates successful long-term investors from everyone else. One of the biggest mistakes investors make is emotional decision-making. Humans are not naturally wired to handle financial markets. When prices go up, people feel excitement and fear of missing out. When prices go down, they feel panic and anxiety. These emotions push investors to buy when assets are expensive and sell when prices are low. In other words, many people do the exact opposite of what a rational investor should do. They chase hype during bull markets and panic during downturns, locking in losses instead of letting their investments recover. Another major reason investors lose money is a lack of patience. Many people expect quick results. They want fast profits and instant success. However, the most powerful force in investing is time. Wealth is built through compounding, which requires years, not weeks. Constantly buying and selling, jumping from one investment to another, and reacting to every market movement destroys long-term returns. The investors who succeed are usually the ones who stay invested and allow time to do the work. Poor risk management is another common problem. Many investors concentrate too much of their money into a single stock, a single asset, or a single idea. When that one investment performs badly, their entire portfolio suffers. This lack of diversification increases volatility and emotional stress, which then leads to even worse decisions. Smart investors spread their money across different assets to reduce risk and protect themselves from unexpected events. Many people also lose money because they follow hype instead of fundamentals. Social media, news headlines, and online forums often promote certain investments as guaranteed winners. But by the time something becomes popular, most of the potential gains are already gone. Buying based on excitement rather than research leads to buying at inflated prices. Successful investors focus on understanding what they are buying, not on what is trending. Another critical factor is overconfidence. Some investors believe they can beat the market consistently through trading, timing, or predicting short-term movements. In reality, even professional fund managers struggle to outperform the market over long periods. Frequent trading increases costs, taxes, and mistakes. A simple, disciplined strategy often beats complex and aggressive approaches. Finally, many investors fail because they do not have a clear plan. They invest without knowing their goals, time horizon, or risk tolerance. Without a plan, every market movement feels like a crisis. A strong investment strategy provides structure and helps investors stay calm when markets become volatile. In conclusion, most investors lose money, not because markets are unfair, but because of emotional decisions, lack of patience, poor risk management, and chasing hype. The key to long-term success is discipline, diversification, and a clear strategy. Investing is not about being fast or lucky. It is about being consistent, patient, and informed.